Hello, today I'm going to introduce DeFi lending. So in the following, I will introduce how does DeFi lending work, its benefits and constraints, and then I will talk about some example of the current DeFi lending platforms. And finally, I will briefly talk about the future of the DeFi lending. The rise of DeFi has strengthened the prospects of blockchain implementation in the development of financial apps. DeFi, or decentralized finance, has recently gained prominent attention as it has gained massive amounts of capital for various businesses. You will be surprised to know that there's almost 20.46 billion is locked in DeFi protocols, proving that the popularity of the DeFi applications has escalated to a considerable margin. This has influenced the growth of DeFi lending. DeFi lendings are one of the upsurging parts of the cryptocurrency ecosystem. These types of loans are now allowing crypto holders to lend their assets and gain lucrative interest. In simple words, DeFi lending is all about offering crypto loans on a decentralized platform. Among all the decentralized applications, DeFi has the highest lending growth rates globally. Is one of the prominent contributors utilized for locking crypto assets. Now let's move on to discuss the commonly asked question: how does DeFi lending work? DeFi lending is quite similar to the traditional lending service offered by the banks, except that it is offered by the P2P decentralized applications. The DeFi lending platforms help people borrow and lend funds which allow the crypto holders to earn a substantial income. The DeFi lending process is simple. It focuses on offering crypto loans with a trustless approach. This means that the users can easily lock their crypto assets on the DeFi lending platform without worrying about the intermediaries. The borrowers can directly opt for loans from the decentralized platform with the help of P2P lending. And how DeFi lending works in detail. DeFi lending, in which a user deposits their funds into a protocol, resembles a traditional cash deposit or investment that accrues interest over time. Lenders not only earn interest on their digital assets, but receive a governance token or DAI as an additional incentive, like compound reverse comp, and RV generates land, and Maker issues DAI. For retail users, the 3 to 5% interest for lending is superior to many banks, but may not be enough to justify the alpha percent risk of smart contract exploits. For high capital investors, hedge funds, or institutions, however, these rates appear very attractive, particularly when applied to stablecoins like USDT, USDC, or DAI. Lending can also help mitigate the dangers of market volatility, since users passively earn capital without trading. For the most part, lending rates adjust with each Ethereum block. Price oracles help determine the ideal annual percent yield, which fluctuates to keep the protocol running safely. When users lend cryptocurrency, they receive platform-specific tokens in return, like C tokens for Compound and A tokens for RV. The platforms use these tokens to determine your accrued interest and are necessary to redeem your funds. And how DeFi borrowing works. Most assets locked in a lending platform are not there to only generate interest. Becoming a lender is the tip of the iceberg. And the real magic happens when we look at the possibilities of what lenders can do. Before getting to that, though, it's important to understand collateral. Decentralized protocols require no permissions to use. Therefore, its services cannot rely on conventional evaluations like credit score, equity, or income to determine a safe loan amount. Instead, lending platforms require borrowers to put up crypto assets as collateral. DeFi loans are always over-collateralized, which means that users can only receive a portion of what they put up as their collateral. If you lend 10,000 in Ethereum, you can acquire up to 7.5 thousand of DAI or other assets, which is approximately 75% of your collateral. This may seem counterintuitive at first, but is necessary to ensure that every user can pay back their loan. If you can't pay back what you borrowed, you risk the liquidation of your collateralized assets. Compound, for example, only offers variable interest rates for loans, while Aave users can select from fixed or variable interest rates. Since variable rates change, they expose borrowers to liquidation if the annual percent yield exceeds a certain threshold. These variable rate loans demand daily diligence and attention. They are, however, frequently lower than the fixed rate loans, depending on the current amount lent and borrowed. Okay, now DeFi lending and borrowing combined, we can see that over-collateralization raises a big question. Why would you want to borrow against your own assets for a loan that's worth less than your collateral? This is simple because many crypto holders don't want to sell their most treasured assets. By lending their capital, they can unlock liquidity without trading. For example, if someone has 10,000 Ethereum but doesn't want to sell it, he or she can supply it to a lending protocol and borrow up to 75% of that value. This opens up a world of possibilities. Crypto traders can execute margin trading on the open market, acquire a token they don't own for liquidity mining, or take out a short-term loan for the real-world emergencies, all without selling a single asset. Crypto lending can be particularly valuable for hedge funds and institutions that hold crypto as part of their portfolio. They can borrow against their own crypto assets, receive a loan, and move it to the traditional financial instruments. For the current use cases, as of today, borrowers have been using DeFi lending protocols for two main purposes. The first one is earning rewards. At the moment, the primary motivation for ordinary retail users of DeFi lending protocols has been to receive participation rewards in the form of variable or tradable governance tokens. In the extreme, borrowers would repeatedly borrow and then redeposit the borrowed funds as collateral and then borrow again. As such, a borrow spiral is formed to maximize the amount of reward tokens that a user can receive. And the second use case will be the leverage trading. Leverage trading is commonly seen among more sophisticated investors as well as the institutional investors such as the hedge funds. For example, an investor bullish about the Ethereum may borrow, say, DAI to buy some Ethereum. In expectation of a price increase of Ethereum, investor would swap borrowed DAI for Ethereum on an exchange, hoping that the purchased Ethereum can be worth more DAI in the future to such an extent that it exceeds the loan amount and leaves the investor some profit. Similar to the borrow spiral discussed above, an investor can repeatedly borrow DAI and then swap DAI for Ethereum and then deposit Ethereum as collateral and then borrow more DAI again. As such, a leverage spiral is formed to maximize the investor's long exposure to a crypto asset that is expected to appreciate. After introducing the DeFi lending working principle, so how is the DeFi lending different from the traditional lending? The traditional financial system provides borrowing, lending, margin trading, and spot trading. The DeFi ecosystem, however, has adapted and can offer similar financial services. One of the crucial differences between DeFi in the traditional lending is that conventional banking involves a time-consuming process along with some continuous checks on a customer's status. DeFi, on the other hand, grants loans quicker as long as the individual meets all of the collateral requirements. The smart contracts take care of the entire reviewing process, making it easier for the borrower and the lender. DeFi lending typically offers better returns when compared to the traditional lending markets. For the next part, we are going to talk about the benefits of DeFi lending. DeFi lending mainly works by engaging the participants to contribute funds by depositing them at interest. These interest rates are more lucrative than the rates offered by traditional banks. Other than that, there are multiple benefits of DeFi lending as compared to the traditional lending system. These include their accountability. The accountability is one of the top benefits of DeFi lending. Blockchain is a public ledger that can offer on-demand records of all the DeFi loans, along with the policies and rules that granted that loan. The public distributed ledger mainly serves as a proof of all the financial transactions when a particular DeFi loan gets granted. And the second benefit will be the lending analytics. Having a complete digital process for lending mainly helps in the assessment and monitoring of the borrowing and lending market. Lending analytics is another major benefit of the DeFi lending process. The lending analytics can be utilized for optimizing funds. It also allows various DeFi lending platforms to gain insights on loan sources that can help them improve the performance of the loan. And the third benefit will be the immutability and transparency. Blockchain can be easily verified by any user present in the network. DeFi lending ensures the transparency as the decentralized nature of the blockchain mainly ensures that all the transactions are genuine. And the last benefit will be the permissionless. Decentralized lending offers permissionless and help access to anyone with a DeFi crypto loan wallet. One can easily access the DeFi applications built on blockchain networks regardless of the presence of their fund or geographical location. From the above, several prominent discussions about the decentralized finance largely focus on its benefits. However, it's equally important to highlight the cons for analyzing its potential effectively. Here is a list of the critical constraints of the DeFi lending. First of all, it's about the uncertainty. If there is any instability while hosting a blockchain in a DeFi lending, then the process can automatically inherit instability directly from the host blockchain. Currently, the Ethereum blockchain is undergoing various changes. For example, the mistakes committed during the proof-of-work consensus transitions to the new Ethereum 2.0 POS system could lead to risk. And the second constraint will be the scalability. DeFi lending can encounter difficulties maintaining the scalability for the host blockchain from various aspects. For example, the DeFi transactions require more time for confirmation. At the same time, the DeFi protocol transactions could become a bit expensive during the construction period. Overall, this affects the entire scalability. The third constraint will be the shared responsibility. Amongst all of the disadvantages, the shared responsibility factor completely works the opposite for the users. If there is an error from the user's end, the DeFi projects do not take any responsibility. All they do is take away the intermediaries. So only the user becomes responsible for their access and funds. Therefore, the DeFi lending process requires tools that can prevent the possibility of human errors or mistakes. And the fourth constraint will be the liquidity. Liquidity is another crucial factor in the blockchain protocols and DeFi-based lendings. We can see that the market value of the DeFi has declined, and a declining crypto market has impacted the DeFi lending process. Therefore, it's evident that the DeFi market is not as trustable or big as the traditional financial systems. So it can be difficult to put your trust in a sector with liquidity concerns. In the following section, we will talk about the top DeFi lending platforms. DeFi lending platforms offered loans to business or the public with no intermediaries. DeFi lending protocols enable people to earn interest on cryptocurrency and supply stablecoins. Here is the list of some of the top DeFi lending platforms. And in the following, we will introduce one of the example, Compound. Compound is a kind of autonomous interest DeFi lending rates protocol utilized for open financial applications. Users can directly earn a passive income by depositing the cryptocurrency through borrowing and interest crypto. Compound grants the holders the right to vote on certain decisions, like technically upgrading the platform and adding new assets. As a crypto lender, you will get a C token as per the amount they supply to the liquidity pool. A C token is specific to those digital assets provided in the liquidity pool. These tokens will earn interest based on the liquidity pool's respective interest rate. The top three markets on Compound are USDC, Ethereum, and DAI. Users of the Compound protocol can supply and borrow Ethereum, as such as an array of the ERC20 tokens. Users who deposit crypto assets into the protocol's smart contract will receive some C token of an equivalent value, which can be used in exchange for the deposited assets plus interest in the future. A C token is an interest-bearing token, whose exchange rate against the deposited assets increases over time. To borrow from the protocol, users first have to deposit funds, which are used as collateral for the borrowing position. In that sense, a borrower must first and foremost also be a depositor. The Compound protocol computes and updates borrowing and lending interest rate for each asset automatically and continuously, based on the amounts deposited and locked, as well as the amounts borrowed. The funds borrowed thus accrue interest in a time-variant manner. This is a maximum amount of funds that the user can borrow against his collateral. The market value of assets is determined through the protocol's price oracle. As both borrowed assets and collateralized assets experience price movements and accrue interest, the collateralization ratio of a borrower's position changes continuously. Despite the absence of a fixed loan term, the borrower needs to ensure that the over-collateralization of his borrow position, such that the collateral does not become available to be liquidated by other network participants. Next, we will talk about the regulatory developments. As the DeFi space matures, regulatory frameworks are expected to evolve to address the unique risks and challenges posed by the decentralized finance. Platforms that proactively address regulatory concerns and collaborate with regulators will likely have a better development in the changing landscape. Some of the key regulatory concerns that DeFi platforms will need to address include the following. The first one will be the anti-money laundering (AML) and countering the financing of terrorism (CFT). DeFi platforms must be able to comply with AML and CFT regulations, which require them to identify and report suspicious activity. This can be a challenge for DeFi platforms, which often lack some level of customer data as traditional financial institutions. The second one will be the protocol governance. Given that everyone must play by the code in the decentralized environment, security requirements for protocols are extremely high. Unfortunately, there persist vulnerabilities and loopholes in smart contracts which attackers exploit and profit from. In particular, malicious users are seen to abuse certain features of the DeFi lending protocols to perform, like the flash loan funded price Oricon attacks. The nature of the blockchain plus the absence of central authority makes it challenging for attack victims to claim damage. As it stands, the community still resorts to regulations to deter malicious activities. In the long run, an improved protocol governance will lead to system resilience, and the dependence on law enforcement external to the decentralized ecosystem will be reduced. The third one will be the consumer protection. DeFi platforms must protect their users from fraud and other risks. This includes providing clear and accurate information about the risks associated with DeFi investing, and offering safeguards such as the insurance and dispute resolution mechanisms. By proactively addressing these regulatory concerns, DeFi platforms can build trust with the regulators and investors, and position themselves for success in the long run. For the final part, let's talk about the future of the DeFi lending. Regarding the technological advancements, continuous advancements in the blockchain technology will enhance the scalability and efficiency of the DeFi lending platforms. The adoption of Layer 2 solutions, improved consensus mechanisms, and enhanced interoperability will shape the technological landscape. First of all, the Layer 2 solutions can help to reduce the congestion on Layer 1 blockchains, which can improve the speed and efficiency of DeFi lending transactions. Some popular Layer 2 solutions include the Matic Network, Loopring, and Optimism. Improved consensus mechanism can help to make blockchains more scalable and efficient. Some examples of the improved consensus mechanism include Proof of Stake (POS) and Proof of Authority (POA). Enhanced interoperability can help to make it easier for DeFi users to interact with different blockchains and DeFi platforms. Some examples will include the use of bridges and cross-chain protocols. These advancements in blockchain technology will make DeFi lending platforms more accessible, efficient, and secure. As a result, DeFi lending is likely to grow in popularity in years to come. And for the predictions for the 2024 and beyond, the future of the DeFi lending platforms hold exciting prospects, and some of the anticipated trends include the following. First of all, regarding the emergence of innovative financial products tailored to users' needs. DeFi lending platforms are not limited by the same regulations as traditional financial institutions, which gives them the freedom to innovate and create new financial products that meet the needs of the users. This could lead to the development of new products such as the P2P lending, microloans, and asset-backed lending. And secondly, the integration of the AI for risk assessment. We know that AI can be used to automate risk assessment process, which can lead to faster and more accurate lending decisions. This can benefit both lenders and borrowers, as it could reduce the risk of default for lenders and make it easier for borrowers to obtain loans. The third will be the increased collaboration. DeFi lending platforms are still in their early stages of development, and there is much to be gained from collaboration with different platforms. This could lead to the creation of a more robust and efficient lending ecosystem, with lower interest rates and greater access to credit for borrowers. These are just a few of the trends that can be expected to shape the future of DeFi lending platforms. As the industry continues to grow and evolve, we can expect to see even more exciting developments in the years to come. That's all of my presentation. Thank you.